America's getting poorer. That's the bottom line here. And I don't think it's going to fly, shall we say, in November. We've got the CPI data out. We've got the PPI data out. And any way you slice it, really. And I know there are those, producer prices, they're going down a little bit. Not enough, guys. Not enough. Any way you slice this, Americans are getting poor. That's the reality of it because our dollars are not going as far. We've had all kinds of government interventions that is supposed to actually guard against this kind of stuff, right? Well, I'll tell you now, as I've told you before, it never works, never does, never has, never will. And the more they interfere, the more treacherous it becomes for every single American. Welcome to the show. Good to have you here. I am Trish Regan. If you haven't signed up on Apple, iTunes, or on Spotify, please do me the favor. Go over there, sign up. Make sure you are subscribed to this show. It's really important. I'm also on Rumble. I'm also on YouTube and on Facebook. I love having you here. So thank you for that. Portions of today's program are brought to you by Legacy Precious Metals. There's never been a better time to invest in precious metals than right now. So go to legacypminvestments.com for more. Again, that's legacypminvestments.com for more. And we got to talk about gold as it relates to this wild market in just a second. But first, what's really happening here? Look, Americans are getting poor. And even though there are those that will try and celebrate any kind of increases they see in wages, you can't look at those in a vacuum. You need to look at them relative to what's happening on the inflation front. And because inflation has been so severe and will continue to be severe, mark my words, I predicted this way back when, did I not? Actually, as far back as summer of 2020, I told you we'd be looking at this. Because you cannot have this much stimulus and not have a hangover effect. So this is going to be ongoing. And I think the Federal Reserve should be, if they're not, looking very closely at maybe a full point of a rate hike when they meet on September 20th, 21st. We'll know the answer to that. That's going to come with additional pain. So what you saw reflected in the markets yesterday, well, actually, that would be Tuesday, the 1,300 point drop. Well, that's kind of natural, right? Given where we are heading, what the trajectory is on the macroeconomic front. There's a lot of inflation reads that we got, the PPI, the CPI. Let me just first start with PPI. I think this is interesting because this is wholesale prices. This is what consumers are paying, right? So the local restaurant down the street, if they're making and selling pizza, they got to buy the cheese, they got to buy the tomato sauce, they got to buy the flour. And what we've seen is that producer prices had been escalating so severely. And I've told you before, if the producer has to pay more for his stuff, then they're going to have to pass that on to the consumer, right? Natural, makes sense. And so you see this sort of lag factor between what producers pay and what consumers pay, because it takes a little time to pass all those costs along. I mean, at first the pizza restaurant is like, well, can we really charge 50 cents more a slice or $1 more a slice? We're not sure. Let's test it out. And so it takes a little time for it to catch up to CPI. Well, a little bit of good news in that we saw this week, producer prices came down a touch from the month before, but they're not coming down at the rate we need them to in order to have a big impact on inflation. So while that's encouraging, I'd still point out the headline, which is that producer prices, wholesale prices, are still 8.7% higher than this time last year. So that's not good. Meanwhile, consumer prices are still much higher, as we saw reflected in Tuesday's number. So inflation's up. And while some politicians will try and spin it, and the media as well, by the way, I did that the other day on the show. The media is going to spin this, right? They try and tell you, it's really not as bad as everybody wants you to think. Well, let me just say, look, if you're buying groceries, if you're paying your utility bills, if you're putting gas in your car, even though gas prices have been coming down, and I don't think they're going to be down forever, by the way, because of some of the restrictions that are happening internationally and as well as on the drilling on our own land, I think that everyday Americans still feel it. They know it, right? That's what we saw reflected in the Gallup poll the other day. The country feels it. And so consequently, there are those that are saying, well, maybe the Fed shouldn't raise as much. Elon Musk coming out with a tweet just yesterday saying the Fed should hold off. In fact, they should cut. They should cut by a quarter. Interesting, but then the party just lives on and on and on. Somebody should have broken this party up a long time ago, right? I think that's just the reality of all of this. And we have irresponsible lawmakers. Nobody wants to take any pain in the here and now. It's like kick the can down the road and kick it some more. And everybody wants to make it somebody else's issue, somebody else's problem. I'm reminded of the public school system in some of the most challenging, poorest places in America where they just keep pushing the kids through. Heck, in Baltimore in 2017, 0% proficiency in math from high school students there. They were graduating them with 0% proficiency in 13 Baltimore high schools in math. Look, we can't be like the Baltimore public school system. We need a Federal Reserve that takes more ownership and more responsibility. We can't just let the party keep going, and never, ever should have gotten so out of hand to begin with. But at some point, the adult in the room has to jump in and say, okay, enough is enough. Party's over. We're going up a full point. I mean, I think that's the right thing to do. And I actually think the markets would welcome it because we need somebody with responsibility, somebody like, oh, I don't know. Hey, can we get Paul Volcker back? I mean, look, we need somebody who's willing to take the lumps because there's going to be a lot of lumps. And Joe Biden's not going to like it, and the Democrats are not going to like it, and it's going to be miserable timing. We're going into November. I get it, but you know what? You never should have allowed all this craziness to happen in the first place. It's part of the reason why when I look at a market like we saw on Tuesday, and we were off 1,300 points there, I think you got to think about a whole lot of things. Are we at a bottom? I don't believe we are. I don't believe we are because there's more pain to come as a result of what the Federal Reserve needs to do. So we're not at the bottom. How do you manage volatility in light of what's going on? I mean, that gets me back to gold, of course, right? Gold, Legacy Precious Metals, wonderful sponsor of this program. So you hear me talk about them a lot, but gold is just one of those things that I do think helps iron out the fluctuations, the volatility in your portfolio. In fact, on Tuesday, the market, the S&P was off more than 4%. I think it was 4.3% that we were off. But, you know, gold was down 0.25%, like 0.23%, I believe, on the day. So people say, oh, it's down. Well, you know what? It's down, but it's not down as much as it could be. And so it's not perfect. I'm not saying go out and put all your eggs in one basket. Certainly not me. I'm such a believer in diversification, but I am reminding you that having something like gold in your portfolio is very helpful for really, really bad days. So consider investing in something like gold. And when you do, call my friends over at Legacy Precious Metals. LegacyPMInvestments.com is their website. You can get your free investing guide or call 1-866-589-0560. Again, 1-866-589-0560. Are we at a market bottom? Look, I think one of the big things that you'll always need to keep an eye on, you hear me say this, is the VIX. The VIX measures volatility. It's basically looking at the options market and determining how expensive some of these options are getting. And so by looking at that, you can gauge how much fear is out there. To me, what was it, in the 20s? Let's see, somewhere around 24, I believe, on Tuesday, which to me just wasn't enough. Look, you need more fear in order to get yourself over these concerns about what's going to happen when the Fed raises rates. Because when the Fed keeps raising rates, mortgages, 30-year fixed now above 6%, they're going to go much higher than that, which is going to have all kinds of other implications for our economy. In Tuesday's trading, we saw the VIX up around 27, 28. Look, whoopee, right? To me, I know there's real fear when I see the VIX, say, in the 70s, like 75 or so, which is where it was in March 2020. And I was saying this is overdone. I mean, at that point, it was overdone, the fear, if you would. The other time we saw so much fear in the marketplace where it wasn't perhaps as crystal clear what was really going to happen was back in October of 2008. And you had the VIX then at 89. It took a long time for the VIX to come down from pretty escalated levels. But hey, you know, a VIX in the 20s or mid 20s or even high 20s, that's not that big a deal. I start to perk up and start getting a little more interested, at least when we're in the mid 30s into the 40s. In light of what's still coming, people are still too optimistic. You had about $2 billion worth of equity stocks and ETFs being purchased by individual retail investors on Tuesday. So the market's down 1,300 and everybody's like, oh, okay, this is my time to get in. And of course, they're listening to people who say, you got to remember, you buy low and you sell high. Timing's tricky, right? So they're like, okay, off 1,300 points. Now is my chance. But what I don't think that they're really thinking through, number one, everything else that's going to happen in terms of the macroeconomy because of what the Fed needs to do. And two, they're not taking into account whether or not there's enough fear, which clearly there wasn't because they were all rushing in. And the VIX effectively proved it, right? When the VIX was trading in still the 20s, you knew that people were not really, really worried. I say that only to say, one, very hard to time a market, right? You cannot really accurately time a market. It's an extremely difficult thing to do. In fact, it's one of the reasons why it's smart to look at ETF style investing and just say, okay, you know what, every single week, I'm just going to keep dollar cost averaging in and going in and avoid the whole timing aspect altogether. Nonetheless, everybody wants to make sure that they're not pulling out all their money at the worst possible moment or investing at the worst possible moment. So it's tough. I would just say, remember, look at that VIX. That tells you a whole lot. Keep looking at that and think about the economic fundamental challenges that lay ahead. We could keep this party going, but all we're doing is creating bigger and bigger and bigger problems for ourselves and for our children in the future. So let's be willing to take ownership of what's really going on. Thank you so much for joining me. Please make sure that you are subscribed. Go to my website, trishintel.com, where we have all the latest news and information. You can sign up for my newsletter there, and I'll see you right back here tomorrow.